All right, so for most of our lives, the advice has been pretty simple, right? Put your money in a bank and just let it sit. It's the safe option, the simple option. But what if that's not the whole story? What if your capital could be something you actively program instead of just parking it somewhere? That's what we're digging into today, this really fundamental shift in how we can think about and interact with our money. So this is the big question, the one we're going to keep coming back to. Is your money just being stored somewhere, or is it being actively positioned? The answer really gets at the heart of the difference between traditional finance and these newer decentralized systems. It's the difference between being a customer, buying a product, and being the operator of your own little financial engine. So let's start with what we all know. Okay, first up, the old model. We're talking about a world of financial products and really trying to get our heads around the limits of traditional savings. This is the stuff we all grew up with, the system built for convenience. So when you look at the traditional toolkit, it's the usual suspects, right? You've got your basic savings account, which is really just a place to store your money. Then you have certificates of deposit, or CDs, where the deal is you lock up your funds for a while, and in return, you get a little bit more yield. And of course, money market funds, which are basically just a prepackaged bundle of short-term debt. See the pattern here? Every single one of these is a pre-made product handed to you by a big institution. And that really brings us to the core principle of the whole thing. At the end of the day, you are putting your money into someone else's system. And because of that, you have to play by their rules. You accept their business hours, their transfer limits, all their restrictions. It's a system that's fundamentally built on you needing their permission. Okay, so now let's flip the script and look at the new model, a world of what we call financial primitives. This is all about how decentralized finance completely changes that relationship with your money. Instead of buying a finished product, you get the raw ingredients. Let's make this super clear with a direct comparison. A traditional savings account, it's all about custody. It's designed to just hold your money. But a stable lending protocol in DeFi, that's designed for programmable yield. Your capital isn't just stored, it's made productive. It's actively participating in a market. And the best part? The rules aren't made up by some committee in a boardroom. They're governed by transparent code that anyone can look at. And we can take this a step further. Think about a CD. It's basically a static box. The whole point is to lock your money up and you get rewarded for just waiting. But when you look at more advanced DeFi systems like these fluid-style capital systems, they're not static containers. They're more like an active capital engine. They aren't designed to reward waiting. They're designed to reward smart positioning. It's all about enabling strategic flexibility, not restricting it. And this quote really nails it. Traditional finance sells products. DeFi exposes primitives. That's the whole game. Think of it like this. A bank sells you a fully built Lego castle. DeFi gives you a giant bucket of Lego bricks, the primitives, like lending, borrowing, collateral, and says, here, build whatever you want. You get to be the architect. But look, this isn't just about chasing a slightly higher yield. It's way bigger than that. We're talking about a whole new financial grammar. And to understand it, we need to get our heads around two really powerful concepts: smart collateral and smart debt. Okay, so what is smart collateral? Well, normally when you use something as collateral, it's just locked up, sitting there doing nothing. It's static. Smart collateral is completely different. It's active. It's part of the system's design. The best analogy is this. Imagine using your house as collateral for a loan, but you could still rent it out and earn income from it at the same time. That's what smart collateral does. Your asset can back a loan and be productive simultaneously. It's a total game changer for capital efficiency. And then there's smart debt. Now, usually we think of debt as a bad thing, right? A liability, a burden. But in this new world, you can think of it as a tool. It's a programmable, collateral-aware instrument. It's not just a rigid loan. It's more like a super flexible line of credit that you control, one that you can use to make your capital work even harder for you without having to sell your underlying assets. So this is where the magic really happens. This is how it all comes together. Your capital can suddenly do multiple things at the same time. Let's walk through it. First, you hold an asset you believe in for the long term. Simple enough. Second, you use that asset as smart collateral in a system. Third, you borrow against it using smart debt. And fourth, you can take that borrowed capital and redeploy it somewhere else. You see what just happened? One single asset is now doing 4 different jobs. That's not just an improvement, that's a whole new language for finance. Okay, but let's be real for a second. All this power, all this sovereignty, it's not a free lunch. With great power comes great responsibility, right? It's so important to understand this. You aren't getting rid of risk. You are just trading one kind of risk for another. So let's break down that trade-off. In the old centralized world, your risks are things like the bank delaying your transfer or being completely dependent on them. But in the decentralized world, the risks are different. You're now responsible for things like potential bugs in the smart contract code or understanding liquidation mechanics. That's when your collateral can be automatically sold if markets move against you. And of course, the big one, you are your own bank, which means you're responsible for keeping your funds safe. You're shifting from being a customer to being an operator, and that comes with a whole new job description. And what's really fascinating is that this huge shift, this move from being a user to an owner, it's not just a finance thing. We're seeing the exact same pattern play out right now in AI, which is arguably just as transformational. Just think about how most of us use AI today. We go to a big platform, maybe a ChatGPT or something similar, and we're essentially renting intelligence from them. It runs on their servers, by their rules. The alternative that's starting to emerge is what you might call sovereign AI. That's where you own the infrastructure, running powerful models on your own machine. It's private, it's specific to your needs, and you control it. See the parallel? It's that exact same leap from renting something to truly owning it. So, if we boil the whole financial shift down to one sentence, it's this. Banks give you custodial convenience. Protocols give you programmable capital. And the exact same pattern in AI. Centralized AI is rented intelligence. Sovereign AI is owned infrastructure. When you zoom out, you see that this is the real story. This is the thread that connects both of these worlds. The fundamental shift, maybe one of the biggest of our time, is from a world that runs on permission to a world that runs on ownership. So let's end with this one thought. A CD rewards you for waiting. A decentralized capital system rewards you for positioning. And that really leaves you with a very simple but very profound question. In this new world, do you want your money to just sit and wait? Or do you want it to get to work,